What if some of the biggest turning points in financial markets weren't driven by earnings, charts, or even interest rates, but by something far more human: political survival? What if the stock market, at critical moments, becomes less about fundamentals and more about timing power, incentives, and psychology? Stay with me, because by the end of this video, you'll see market cycles through a very different lens, and it may permanently change how you position capital. At World Economics HQ, we don't chase headlines. We study patterns, incentives, and repeatable behavior. And today's story begins with one of the most remarkable long-term track records in market history. We're talking about a trader who compounded capital at a rate most funds can only dream of, year after year, decade after decade. Not by guessing tops and bottoms, but by understanding how the system itself behaves. Here's the uncomfortable truth most investors don't want to hear. Markets are not neutral. They exist within political systems, monetary systems, and human ambition. And once you accept that reality, certain cycles become impossible to ignore. Think about what every administration wants above all else heading into an election: stability, growth, rising asset prices, confidence. Because voters don't cast ballots based on bond curves or fiscal theory. They vote based on how they feel. Are jobs available? Is their retirement account growing? Does the economy look healthy? That incentive alone creates pressure. Pressure to stimulate. Pressure to support markets. Pressure to delay pain. And when incentives align repeatedly over decades, patterns form. When you step back and study long-term market history through this lens, something striking emerges. The strongest equity performance has tended to cluster, not randomly, but around specific phases of the political cycle. Early in a presidential term, markets often struggle. Growth slows, liquidity tightens, tough decisions get made. But as elections approach, the environment frequently shifts. Financial conditions ease, sentiment improves, risk appetite expands. This isn't theory, it's observable behavior. When long-term data is grouped by election cycles rather than calendar years, the results become difficult to dismiss. On average, the latter half of presidential terms has produced meaningfully stronger equity returns than the early years. That doesn't mean every cycle is identical. It means probabilities lean in a particular direction, and markets are a game of probabilities. Now here's where things get really interesting. When you overlay this political rhythm onto historical price charts, you start noticing how often major market lows have appeared near election transitions. Periods of stress, corrections, and resets frequently occur when a new administration inherits an economy that was pushed hard in the prior cycle. Stimulus fades, reality reasserts itself, excess gets wrung out. In other words, markets don't just rise, they breathe. Expansion followed by digestion. This insight alone doesn't make you money, but used correctly, it can dramatically improve how you deploy capital. Because the goal of professional trading is not maximizing returns at all costs. The goal is efficiency. Avoiding the worst periods, staying solvent, preserving emotional capital, and positioning size when the odds are more favorable. Let's address the obvious counterargument. Yes, if you bought the S&P 500 decades ago and held through everything, you would be wealthier today. That's true on paper. But paper returns ignore drawdowns, volatility, and psychology. They ignore the reality of watching your portfolio drop 50 or 60% multiple times while being told to just hold on. Most investors don't fail because the market beats them. They fail because they can't stay disciplined through extreme stress. This is where cycle awareness becomes powerful. By stepping aside during historically weaker phases, capital isn't just protected, it becomes flexible. It can be allocated to other assets, other regions, or simply held in reserve. Capital efficiency matters. Cash is a position. Optionality is an edge. This approach isn't about blindly buying or selling based on a calendar. That would be reckless. No serious professional trades that way. Instead, political cycles act as a macro filter, a probability tilt, a context layer. When conditions align, technicals, liquidity, sentiment, and cycle, you press harder. When they don't, you scale back. Same strategy, different exposure. This is how institutions think. Trading isn't about predicting the future with certainty. It's about stacking small advantages over time. And understanding when the environment is statistically more supportive allows you to size trades with confidence rather than emotion. The beauty of this framework is its simplicity. It doesn't require complex indicators or secret formulas. It requires patience, discipline, and awareness of incentives. And here's the part most people overlook. We are approaching another inflection point. Based on historical rhythm, the coming years represent a phase where accumulation, not euphoria, has often laid the groundwork for future expansion. That doesn't mean markets go straight up. It means probabilities begin to shift. It means the conversation quietly changes from defense to positioning. Smart money moves before headlines confirm the trend. At World Economics HQ, our job isn't to tell you what will happen. It's to help you understand how markets have behaved when similar incentives were in place, and how professionals adapt rather than react. Because the traders who survive long enough to compound wealth aren't chasing every rally. They're managing exposure. They're avoiding catastrophic losses. They're aligning themselves with forces bigger than any single indicator. Political cycles are one of those forces. Ignore them, and you're trading with blinders on. Understand them, and you gain context. Context that can improve timing, reduce stress, and sharpen decision-making. Markets don't move randomly. They move within systems. And those systems are built by people with motivations, pressures, and deadlines. If you want to trade like a professional, you must think like one. This is World Economics HQ, where macro meets market psychology, and where understanding the cycle can be the difference between surviving the market and mastering it.